Hey everyone, welcome back to Corporate Decoder, the place where we discover that even SEC filings can have a little drama hidden inside. Today we're diving into a filing from Interactive Strength Incorporated, and let me tell you, it has got more twists and turns than a pretzel factory. We'll uncover some key financial moves and a rather interesting bit of stock shuffling. Before we dive in, if you love getting straight answers from confusing corporate documents, make sure you are subscribed. And hey, if you want to chat about this or any other filing with fellow finance fans, join us on Discord. The link is in the description below. So, what exactly is happening here? Interactive Strength, or ISI as we'll call them, is filing a current report, which essentially means something significant just happened. And it seems like the end of 2025 was a very busy time for them. First up, ISI had some ongoing business with a lender called Vertical Investors, LLC. They had a loan, and some of that loan was converted into preferred and common stock. Now, like many of these deals, there were agreements about what happens if the company's stock doesn't perform well. It looks like a calculation of something called net trade value versus the total loan exchanged amount fell short. So on the 31st of December 2025, the company and the lender sat down and signed a settlement agreement. To cover the shortfall, ISI issued 16,875 shares of their Series C preferred stock to Vertical Investors. This was pretty much to settle that specific part of the debt, but that wasn't all. They also entered into an exchange agreement. At this point, the outstanding loan amount, including interest, was about $170,250. Through this exchange agreement, they knocked that down by a chunk, specifically $156,202, by handing over 28,400 shares of their common stock. The price per share here was $5.5. This effectively reduced their debt way down to just over $14,000. Now these shares don't have any special legends on them, meaning they are more freely tradable. Things get a bit more complex when we talk about warrants. Back in January of 2025, ISI had already agreed to sell some warrants to an investor. These aren't just simple warrants, they are called Class A incremental warrants, and they come with a bit of a formula. These warrants are tied to the purchase of senior secured convertible notes, and then in turn to warrants for common stock. The number of common shares you get is based on a pretty involved calculation involving the principal amount, the closing stock price, and a conversion price. Now, they give a very specific example here to explain it. If $1 million worth of notes were bought and the stock price was $0.9 on the day before the warrant was exercised, then that investor could end up with over 500,000 shares of common stock. This shows how sensitive these warrant calculations are to stock price. Fast forward to January 2026, and this investor decided to exercise their warrants for another $1,153,000 principal amount. This exercise resulted in them getting warrants for over 618,000 shares of common stock. This is a pretty significant number of shares potentially coming into the market. Now, let's look at the terms of these convertible notes. The investor can convert them into common stock. The conversion price is set at $1.0254 per share, but it is not as simple as just dividing the debt by that price. They get 110% of the principal amount plus interest, any make-whole amounts, late charges, and other unpaid stuff, all divided by that conversion price. This means for every dollar of debt converted, they're getting more than $1 worth of stock value at that conversion price, plus potential upside if the stock price is lower than the conversion price. Then you have the Class A incremental common warrants themselves. These can be exercised for shares of common stock at a price of $1.5756 per share, and these warrants are good for a long time, until January of 2033. A really important clause here is that the investor can't own more than 4.99% of the company's outstanding common stock, or 9.99% if they choose after converting these notes or exercising these warrants. This is a common feature to prevent a single investor from gaining too much control all at once through these conversion mechanisms. They also got shareholder approval to issue a large number of shares related to these instruments, which is a good sign they are aware of potential dilution. Now, let's shift gears to something a bit unusual. This section talks about a material modification to the rights of security holders. It seems Interactive Strength Incorporated had issued about 1.25 million shares of something called Series LTI preferred stock to their executive officers and board members back in June of 2025. But here is the twist. On the 31st of December 2025, the board decided to cancel all of those Series LTI preferred stock shares. And get this, they surrendered these shares for cancellation with absolutely no compensation in return. They essentially gave them back for free, so those shares that were issued to insiders are now back to being authorized but unissued. This could signal a few things, maybe a change in compensation strategy or a need to clean up the cap table for future deals. And finally, as is standard, they list the exhibits that back up all these agreements. We see the settlement agreement and the exchange agreement are both filed. So what is the story here? Interactive Strength Inc. is busy managing its debt and equity through a series of agreements, some of which involve convertible notes and warrants that can lead to significant stock dilution for existing shareholders. The settlement and exchange agreements show them actively working to reduce their debt obligations, which is generally positive. However, the complex nature of the convertible notes and warrants, especially the detailed formula for calculating share issuances, warrants careful monitoring. The cancellation of the insider preferred stock is an interesting move, possibly a positive step towards simplifying the company's structure. Looking at the numbers, the company has a substantial amount of potential dilution from these warrants and convertible notes. While they are settling some debt, the sheer volume of shares that could be issued is a major factor for investors to consider. They are trading on the Nasdaq under the ticker TRNR, and that stock price will be very sensitive to any news that could trigger conversions or warrant exercises. Overall, Interactive Strength Inc. appears to be in a complex financial restructuring phase. They are addressing past debt and setting up new financial instruments. The key risks revolve around dilution from the convertible notes and warrants, and the company's ability to grow its business to support a potentially much larger share count. The cancellation of the insider preferred stock is a good housekeeping item, but it doesn't change the fundamental dilution concerns. Investors need to watch the progress of their business and any potential triggers for these equity issuances. Alright, that is our breakdown of Interactive Strength's latest filing. What is your take on these complex financial maneuvers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.